The Stock of the Day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
So the stock of the day is James Hardie, on news that it will acquire US-based AZEK in a deal valued at around $14 billion. AZEK is a Wall Street listed company which makes outdoor building products, including decking and furniture. James Hardie says that this AZEK acquisition will expand its addressable market and generate at least $350 million of additional adjusted earnings from synergies. The deal includes James Hardie acquiring AZEK's net debt of around $386 million US. The shareholders in the US-based company will receive stock and cash valued at 56.8 US, and that's million, and will own about 26% of the combined company, which will be listed on the New York Stock Exchange and have a secondary listing on the ASX. So you can see there that James Hardie shares are under a lot of pressure today, down by 14%. So clearly, we're not quite sure what to call this smaller company in the United States. However, why is James Hardie's share price down so significantly today? Is it the debt of the smaller company or just the big price tag, or what do you think?
For me personally, I don't like the deal. I haven't looked at it in a lot of detail, Nadine. It only came out this morning, but for a long time, for a good 15 years, there's been a consistent strategy at James Hardie. They are the world leading manufacturer of fibre cement. They have a 90% plus market share of fibre cement, and fibre cement share of the larger building industry has been growing strongly, particularly in North America. So the strategy has long been sit there, expand your manufacturing base, take advantage of scale, increase your distribution footprint, and just keep selling, especially in that North American market. This deal is baffling because it is a complete departure of 15 years of solid strategy. And it came out of nowhere. Management has not articulated a new strategy. They've not hinted at anything changing from the current trajectory. We wake up this morning and there's a huge acquisition, diluting existing shareholders with a business neither of us can pronounce, with an undefined strategy. This is a sell. I have no idea what the CEO and the board are thinking on this, but every red flag you can tick off has been raised with this move.
Yeah, particularly, I mean, I don't want to put words in your mouth, but talking about these amazing synergies to come, also happening, you know, you took it out of the portfolio of the investment committee last month because of the difficulties anticipated in the US economy. Like, why now?
Yeah, that's the part that I don't get. When people make these acquisitions, I mean, Australian companies have a bad track record, let's put it that way. That's a given. James Hardie is a great business model. It makes money in a recession, but it's a pretty weak cycle that they're going into. James Hardie's actually held up. We follow, and it's interesting because only this weekend we sent out to our clients warning about the housing construction index in the US. That's rolled down multi-year lows. Yep. And you know that things are struggling, right? And then you've got trade wars, which of course are going to go up. And and then you've got the problem of in the US, 95% are fixed mortgages, right? And you're at 2-3%. And the current one is 6-7%. I mean, who's going to move that? No one's moving. So everyone's holding onto their house. So it is a tough play. So it is a tough sector, and it's done really well. So we've been telling people to get out of James Hardie for months. And so I'm not surprised. This actually sends, and I'm agreeing with Gaurav here, there's a lot of red flags, right? You're on a weak cycle, you're doing big acquisition, housing cycle, we're at peak. There's a property bubble everywhere, right? Even countries that don't care about property have a property bubble. So it's not a surprise. And this is, it's definitely going to be tricky. And I'm, one of the things I learned a long time ago when I did my MBA is that, you get 10% off all the 10% synergies that everyone tells you. So synergies are always a bad word. It's either a good business or it's not. And I think it's going to be a tricky one. I think it's very high risk. The multiples are really high. It's a cyclical, right? It's awesome, but it's still a cyclical. It's like a CSL. It gives you that pullback. You're going to get that pullback. So I think you're going in the wrong cycle.
That North American housing market, you're right about that. I cover Brickworks as well. Brickworks had a shocking report from North America. Reese is doing really badly there. Ferguson, the Reese equivalent in the US, doing really badly there. That entire market is struggling, and I think it was a good move to get out of Hardie's early, but it almost feels to me as though they can see an earnings decline coming, and they're trying to fill a hole, and that is always a dangerous reason to buy something, especially to make a large acquisition. I mean, this is almost the same size as Hardie's, maybe probably a quarter of the size. So
yeah, it's about third of it.
It's a terrible reason for buying the stock.
And you're going to
get
it's
a sell still?
Oh, huge sell.
Double sell for our stock of the day being James Hardie.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.